So the locked-in buyout with EBITDA, all right, earnings before interest, taxes, depreciation, and amortization is widely used to measure a core corporate profitability. All right, this is important when it comes to buyouts. When you want to get a buyout, in many cases, if you want to get bought out from a large company, they don't worry about the liability as much, so much so of if you were making money. All right. So EBITDA multiple for beverage company buyouts is 12x. It's around 12x. And so during the 1980s, the investors and lenders involved in leverage buyouts, LBOs, found EBITDA useful in estimating whether targeted companies had the profitability to service the debt likely to be incurred in the acquisition. Since a buyout would likely entail a change in the capital structure and tax liabilities, it made sense to exclude the interest and tax expense from earnings. A non-cash cost, depreciation, and amortization expense would not affect the company's ability to service that debt, at least in the near term. Apart from industry and EBITDA range, real-world valuations depend principally on 8 factors: recurring revenue, revenue growth over the last 12 months, key employee turnover, profit margin, competitive advantages, customer concentration, strength in management team, and growth opportunities. So we need to keep this in mind, especially when we talk about locked in. You know, we need the recurring revenues. We need the growth over a 12-year period to be attractive. Are we growing? Are we showing steps of trajectory? You know, are we bringing in people that can get the job done? Key employee turnover. Are we pushing people out who can't get the job done? Profit margin. You know, when we sell a locked-in beverage, are we making money off it, or does it cost too much to make? You know, competitive advantages. What are we doing to set ourselves apart from, you know, the other waters in the world? Customer concentration. Obviously, we have a strong customer base, but how's that going to look when we get out into the outside world? You know, other fitness people, are they going to enjoy this type of water, of hydrogen water, alkaline water, this nootropic? All right. We don't really know that yet because we haven't gotten out there in the real world yet outside of shareholders. But that's, to me, remain to be seen. Strength of management team. We have to consider, you know, is Tom and Joe, are they the ones to get it done long term? They're good for now to get us to the next step. Do we need to add any other leadership positions in to help get us to the point where we want to go, to be $1 billion business? And growth opportunities. All right. Are we getting into different markets? You know, there's a big debate right now if retail is a big option for us, or we should just stay direct to consumer. In my opinion, I think we can stay direct to consumer, but it takes a lot of hustle. It takes a lot of marketing. The thing about retail, yeah, we can get in front of people, but it's a lot of upfront costs. Right now, the company has a lot of debt that right now we have a lot of debt, and we don't want to incur more for a product we don't know that can, you know, hold up within the stores due to the can issue, or, you know, a product that people, because they don't know about it. So these are the things we have to think about with those 8 factors. And so for some gematria, we have EBITDA is good metric for buyouts. We have that 133 in reduction, that 33, you know, you see that big investment number. 12x EBITDA multiple for beverages, 137 English reduction. Again, the 33rd prime. And then we have a big one right here. The buyout company worries about what the company they bought earns minus their debts. 333 English reduction. That's a big one. Again, if the big boy is coming in to buy Lockd'In, they're looking more for if it can make money and if it's growing rather than what the liabilities are. Because in most cases, they can buy whatever liabilities we have. You know, these are multi-billions, you know, tens of $1 billion valuation companies that we're looking at that we want to be bought out by. And so, a $50 million liability for lawsuits or for retail distribution, that's chump change them. That's pennies if we can show that we can actually, sell cans via direct to consumer or in the retail stores. And so I have a big example, even though it's not in the beverage industry, it's a great example of a direct to consumer company that got bought out for $1 billion in cash. It's the Dollar Shave Club. Now, the Dollar Shave Club is like a men's grooming direct to consumers niche type of product where every month they will send out razors to their subscribers, new razors, shaving creams, little trinkets here and there. And they marketed to the manly man for the most case. People who have beards, people who like to be well kempt with their hair. And they're still around, but they hit like wildfire. All right. And this is what a tweet I had. Dollar Shave Club was bought out by Unilever. I think that's a British company in 2016 for $1 billion in cash. And so there's a few reasons why the $1 billion buyout from Dollar Shave Club was a good thing. It started off as direct to consumer. It had subscription service for its products, which we both have for Lockd'In. It catered to a specific niche of passionate consumers in a premium healthcare space. We are in the premium health fitness beverage space. And Dollar Shave Club generated 153 million in sales the year before being bought out for $1 billion. So now they're having that big time multiple. Calculating that out, that was a 6.5 revenue multiple. That was the largest acquisition in e-commerce space history. They made history with that buyout. And so that's very big. Could we go down that path, right? Are we able to go down that path? One second. And so are we able to go down that path? Then we have Lockd'In is focused on the direct consumer business model, has subscription service for products, is catering to passionate consumers within the hydration, healthcare, maintenance. Average with the industry is 10.2, 10 to 12x multiple for acquisitions. So if we could show at least 10 million in sales at some point, we can get that $1 billion. That's within reach. And again, I've been, gung ho about us being bought out by Coca-Cola. They can do it. They have billions of dollars in cash on hand, and they would be able to help us, maybe even with our lawsuits. I've been looking at their history. They've had plenty of lawsuits in the past they've been able to be successful from. So maybe we need to bring them in. And so let's look at some past notable beverage sales in the early years. So I did some research and I went through a couple of the companies that have had either big buyouts or big growth and turned into big companies. So first, I started off with Hansen and Monster, which was essentially bought out by Coke over the years via stock. So Monster Hansen in 1990, they made $100 million $100,000 in sales. Right, that was their first year. In the second year, they did 400,000 in sales. And by that third year in 1992, they did $9.6 million in sales. You see that big jump. So they went from 100,000 in that first year, 400,000 in that second year, and then a big jump to almost 10 million. And that was Monster. Okay. Then we have Celsius. All right. Celsius is more a competitor for us right now. It's a water, but it has caffeine in it. So it's a functional beverage in the space, and it's more modern. Its first year in 2007, it did $1.64 million in sales. That second year, it did $2.58 million in sales. In the third year, it did 5.86 million. So the first 3 years, it was essentially doubling. All right. And then in 2010, it did $8.3 million dollars in sales. So those are the first years of Celsius, which Pepsi has a big stake in. And so for the difference is they didn't necessarily buy out these companies. They chose to buy shares within the stocks. And why Coca-Cola and Pepsi decided to do this is it's less risk and it provides more flexibility. Because when you fully buy out a company, you're taking all that risk on, and maybe it doesn't work out. But if you buy stock within these brands, you can build that up over time. And so now that goes back to the nibbling strategy. They feel out the situation. Okay, we'll buy some shares here, we'll buy some shares there, and if we really like it, we'll keep buying, and then eventually get that controlling interests. Okay. And so for some gematria, again, it's some powerful stuff. Coca-Cola Co. and PepsiCo choosing to buy shares in Monster and Celsius rather than full-on buyout equals 333 English reduction. Then we have Lockd'In's hydrogen water and product line will fully be bought out by Coca-Cola Company, 333 English reduction. That's my goal for Lockd'In down the road. I think in a lot of cases, and we'll see on the next slide, Coca-Cola is lacking in the functional beverage space. Sure, Powerade is second in line to Gatorade, Pepsi's Gatorade, but they need something else. They don't have a Celsius on their product line, and it's showing. And it's shown with body armor. All right. We'll talk about body armor at the end, but let's go to a couple. We understand the significance to Sobe. So the initial CEO for Next Level Lockd'In was Toby McBride. If you didn't know, Toby McBride was a sales representative for Sobe when they got bought out by Pepsi. He was a part of the plan. And Sobe had a 12x EBITDA for their buyout, and that was for $370 million. Their first year in 1996, it was they sold $1.2 million in sales. All right. And by that full second year in 1998, they got it to 67 million. So that was a huge jump in sales, right? Sobe could be the blueprint for us. And by 100 in 1999, they had a 167 million in 1999, and so by 2000 they are expected to do 250 million in 2000 after their buyout. So this is what we have: Sobe blueprint, Lockd'In buyout. Sobe resembles Lockd'In's buyout, 330 English ordinal. And while they have for the next company, while they haven't been bought out, it's a private company. It still shows growth within the beverage space of what we should be able to look towards if we do the correct things. Arizona iced tea, in 1992, they had estimated sales of 10 to 20 million, and then it jumped in 1993 to 130 million. And in 1994, estimated 300 million. So this is the explosive growth beverages can have if they catch on. And that's what we need to look towards. And that's why we need to hustle and get ourselves out there. Because if we can do that, we can start bringing in money once LTNC gets pink, once we spin off, and we start bringing more eyes into the platform for what we're trying to do. And so in regards to body armor launched in 2011. All right. So body armor was bought out by Coke for $5.6 billion in 2021. It was their largest acquisition ever, and that was a 4x EBITDA. If you haven't caught on, the larger the company is, the lower the EBITDA is going to be. It was already a $1 billion business by the time it was a full buyout, right? So that's why the EBITDA is lower. But if the lockheads, the people in LTNC, they want to see money as fast as possible, we want to be looking at a buyout when we start getting into that $100 million range to get to that $1 billion point, right? But if we can, if say if we don't get bought out at 100 million and we keep growing over time, maybe we can get even larger buyout, but that's going to lessen the EBITDA. So for Body Armor, what they did in 2011, they did 2.5 million in sales. They doubled that in 2012 to 5 million. And then they doubled that again in 2013 to 10 million. And so by 2020, they are bringing in $1.4 billion in sales, which brings that 4x EBITDA to 5.6 billion. So Coke really waited late in the game to buy out fully Body Armor. But the issue is how Body Armor is as a functional beverage. It's kind of being phased out. It's still sugary, still has a lot of things you don't need into it, and it's not really a functional beverage. It's like, I would say, a lesser version of Gatorade, with coconut water. And so a recent article that came out in 2023, Coca-Cola struggles to integrate to $5.6 billion purchase of Body Armor. So they're struggling to get that into the mix. All right. They don't understand why it's not catching on as it should. They spent so much money on it. Maybe it's because people aren't really liking it as they thought they were. So they need to look at maybe looking at us to potentially get back into the game, because again, they don't have a Celsius. And I think this is where we could come in as Lockd'In beverages. Maybe they just buy out the hydrogen water. Maybe they just buy out the alkaline water, or maybe they buy out the whole company. All things are possible. All right. And so first, we need to get a couple of things in play. We got to get tradable at some point. We have to spin off. And then once we get those couple of things in order, things will fall into place. We also have to get the product out. We're still waiting on the flavored waters. We're still waiting on the nootropics. I see the nootropics are getting online now, so they should be shipping out soon. But once, we get all the products out, we'll be in a lot better of a space. And so that's what I have buyout wise for LTNC Lockd'In. We're still really early in the game, but it's nice to see some trajectories of other beverages and their successes and what to look out for in the future.